the value of Coke is largely been built up over some, decades, and it's sort of reached an asymptote. And the price of Coke, interestingly, I remember this, believe it or not, kind of overshot this. And Buffett famously said that one of his biggest mistakes was not selling in that period, because this is one of the core dilemmas and sort of advanced value investing is, if you have a compounding machine, should you ever sell? And Buffett's publicly said no in the past. And I think that the reality is some others have said, and including Buffett, have said yes. There is a price that's too high for everything. Coca-Cola is a wonderful compounding machine on its return on equity and its return on assets and things like that. The so-called Buffett return I've described a few times. But you're not getting the price of the original owner. Even if you are the original owner, there is a price that's sort of saying, I'm going to, like this was like 30, 40 times for Coke. And Coke was not growing. It made no sense. This was roughly 2002. And on the assets, like, okay, so this is the Coke plant. This cost, $7 billion in CapEx to create and to maintain. And this is generating $7 billion of cash flow a year. That's 100% return on assets. Well, that's wonderful, but how does that help you as a stockholder? Because the stock's at, 200 billion market cap. Do you really want to pay 200 billion for 7 billion? You cannot increase this return, otherwise they would. And that was the sort of folly of Buffett. And I think he said it was one of his biggest mistakes. Is great, this compounding is fantastic, but I already got the benefits of that. And I cannot compound exactly. I'm only just going to get this 7 billion every year. Now I'm going to get the 7 billion and I could buy back this guy. But at a certain price, is this a sale? At $1 trillion, is it a sale? And the previous message was, no, at no price could it be a sale. And the new message is, at the right price, it's a sale. There's no business quite like Coca-Cola, it's true. But there is a price that, having a reliable cash flow stream, there are other reliable cash flow streams out there. Maybe you'd argue there's none quite as reliable as Coke, but okay, discount a $7 billion annuity at 1% risk. That's worth $700 billion, right? It's cash flow. How do we do this? Cash flow divided by discount rate, right? So 2%, it's 50 times, which is 350. And at 3%, you're at 3% discount rate, which you can get from bonds and other things. So is Coca-Cola safe? Sure, but is it safer than a bond? A senior secured bond in the US government? No, it's not as safe as that. So it's overvalued. So this is a philosophical question. Now, getting back to the point of Tesla, there are markets and situations where investors largely, the investors with the marginal capital remaining are only investors who are sort of comfortable living in the black zone. In high risk markets, they're investors with flush with cash that are comfortable living in the orange zone. And that's why they are living in the orange zone. That's why the price of Tesla is 100 plus times earnings, because there are people willing to buy it and sell it at that price. When capital evaporates in a big market crash or a fear or panic, whatever, the only people who have capital, like Paul Singer at Elliott and other value investors like Buffett, they don't buy stocks in the orange zone. They only buy stocks in the black zone. So the prices have to go to the black zone. So this is really, when I describe that tug of war, it's really a philosophical question more than it is like a question with an answer. In essence, you could argue that it's an M1, M2 question, an M3 question. It's a money supply question. Is there money? If people have money, they will do stupid things with it. They will invest. They will speculate. They'll buy IonQ and Rigetti and D-Wave. But they'll also buy good companies like Tesla. Tesla's a great company. Elon's maybe the best entrepreneur ever. I say that with a huge ego. So, what you're really asking is, when will the money supply change? Because that's really what matters. And sometimes when you're looking at these stocks, what's more important is, what is their ability to capture people's imaginations? That's why quantum rallied, right? That's why all these quantum stocks are up a lot. They're capturing people's imaginations, and there's tons of cash. Tons of cash. No unemployment, so people had money from that. Rising prices and everything, so people had money from that. And so you had companies that are talking about a new kind of computing. Well, you missed the old kind of computing. That was called NVIDIA, parallel computing. You probably missed the first kind of computing, the x86 in the 80s, 90s. You maybe weren't even born yet. So you say, I want the next kind of computing, and that's quantum computing. Okay, great. Whether that's true or not doesn't matter, because you're looking to gamble. You're looking to speculate. And when people take the money away, you can't speculate. There's no money to speculate. You need money for pharmaceuticals. You need money for rent. You need money for a surgery. You need money for a rainy day. Maybe it is a rainy day. You need money for a hurricane. It's when it's bad out there, you can't buy stocks. Why? You might say, well, I save money more. No, I'm not talking about you. When in 2008, my partner and I, Marek, were sitting in his attic, studying stocks every day. I was basically unemployed. My hedge fund had not done well. And like I said, I made a big bet that the market would crash in 2007. I was wrong, because it crashed in 2008. And it was too early. So I was licking my wounds, like a cat. Sitting there with Marek, reading Munger, reading Buffett, forming this philosophical framework that would carry me forward. We started trading and betting with the money we did have, but we didn't have money from institutions. We didn't have money from big backers like CalPERS. Our big backers said, or my big backers, I should say, said, you bet on this market crash and you were wrong. You had the right idea, but it didn't work. So that's that. But the funny thing is, every other fund had the same problem. People took money out from Citadel. Citadel was down 50% at that time. My boss, a Tiger Cub, who had done marvelously, he was up all the time. But he wasn't up enough. He had good returns, which was really hard to do in that environment, but he was up, 10% or 12%, stuff like that. And they said, well, we need that money too. This is New York firefighters, New York pension, Port Authority, guys like that. These guys put 10, 20, 30, $40 million in hedge funds. You don't. You might put $1 million in a hedge fund, maybe. So, those guys needed their capital. And they said, give me the capital back. So even a guy like that, who had 2 or 3 billion, now he's got 2 or 300 million, or something like that. I don't know exactly. And Citadel, who had 20 billion. Now he's got 10 or 8 or whatever. And they're looking at stocks and they're saying, wait, we're deep in the black zone. We're deep in the black. We don't need to speculate. We're paying 2, 3, 4, 5 times earnings for this stuff. But the point is, they don't have capital.